Have you ever felt like you're just guessing about market direction, even with all the charts? Today, we're unlocking a powerful technique. It's something institutional traders use to really confirm their conviction. Not just a gut feeling, right? But a synchronized signal that cuts through the noise and shows you exactly where the big money is actually heading. We're diving into cumulative delta synchronization, specifically across the four major U.S. equity index futures. That's the S&P 500, ES, NASDAQ 100, NQ, the Dow YM, and the Russell 2000, R2Y. And crucially, we're looking at this during regular trading hours, RTH. That keyword, synchronization, that's what it's all about. How these big market barometers line up to give us a clearer picture, a picture of true institutional intent. So let's kick off with the core concept. What exactly is cumulative delta, CMB? Simply put, it's a way to see the net aggressive buying versus aggressive selling over time.
That's basically it, yeah. And what's really fascinating here is how it gives us this direct window, real time, into that aggressive order flow, the institutional footprint.
Yeah.
So the way it's calculated is by looking at aggressive market buys. That's buyers hitting the offer, paying up instantly, and then subtracting the aggressive market sells where sellers are hitting the bid, just wanting out now. You sum those up over time, that difference. So a green or upward sloping CMV line means you got sustained aggressive buying, lifting offers, while a red or downward line, that signals sustained aggressive selling, hitting bids. It's really about seeing that underlying intent, not just, random activity.
Okay, right. So it's a powerful lens for one market. But you always stress, don't you, that no market moves in isolation. Why is looking at just one index, say just the ES, maybe a bit dangerous? Why bring in all four, the ES, NQ, YM, and RTY together?
Exactly, because context is everything. This isn't just about spotting a trend in one place. It's about validating it, getting that market-wide consensus. Think of it like an orchestra, maybe. One instrument might sound loud, but when the whole orchestra swells together, that's powerful. That's conviction.
Ah, I see. The synchronization is the full orchestra playing the same tune.
Precisely. When cumulative delta in all four indexes aligns, all green rising together or all red falling together, that signals broad institutional action, accumulation or distribution across different market segments too, not just tech, not just industrials, everything. This cross-index confirmation, it filters out so many false signals. You might see buying in one index, maybe NQ, but if the others are flat or selling,
then it's not a unified move, maybe just rotation or something specific to that sector.
Right. So if, say, NASDAQ shows huge buying, but the Dow is just flatlining, maybe you hold off on that ES long, even if ES itself looks tempting on its own chart.
Okay, that makes a lot of sense. So the what's cumulative delta and the how many all four indices are clear. But there's a when, that seems just as critical here. Does this signal work the same, like 24/7? Or are there specific times it really shines? Why focus specifically on the regular trading hours, that 9:30 a.m. to 4:00 p.m. Eastern time window?
Yeah, that's a really critical point. It's where, honestly, a lot of people can misinterpret these signals. You might see some wild swings overnight or pre-market. But is that real institutional conviction? Or is it just, thin liquidity making things jumpy?
Right, less volume, bigger impact from smaller orders.
Exactly. RTH helps us answer that. It gives us the most reliable signals. Three key reasons, really. First, liquidity concentration. It's massive during RTH. That's when the big players are most active.
Okay.
Second, the cash equity market is open. So futures and the actual stocks they represent are trading together. It reflects real participation.
Makes sense. They're linked.
And third, you get the major economic releases and rebalancing flows hitting during RTH. So the order flow you see then, it represents genuine market positioning reactions to real news, not just speculative noise. I remember a client, Sharp Guy, telling me how he used to get burned chasing those pre-market moves that just fizzled out after the open.
Ah, the classic fake out.
Yeah. Focusing on RTH for these delta signals, that's what prevents a lot of that.
So RTH is basically when the market is fully awake and doing serious business, not just shuffling around before coffee. All right, let's bring this home for you, the listener. How does this powerful confirmation idea translate into actual trading decisions?
Okay, so for you, the practical application is pretty straightforward. This acts as a high confidence filter. If all four CMVs are green, and importantly, they keep rising together during RTH, that suggests really aligned buying pressure. It significantly boosts the odds for higher continuation in ES if you're looking for long trades.
Higher probability longs. Got it.
And the flip side, if all four CMDs turn red together, dropping in sync, that signals synchronized selling distribution. It strengthens your conviction for short setups in ES.
Okay.
But here's the key. What if they don't align? What if NQ is green, but YM and RTY are red?
Then the sigil is weak, or maybe just noise.
Exactly. If the deltas diverge, the market's fragmented. The signal lacks reliability. You probably want to be cautious, maybe stay flat. So think of it as a robust confirmation tool. It reflects that true underlying institutional flow. It enhances your confidence in a direction, but always, always remember, it complements your existing technical setups and your risk management. It doesn't replace them.
Right, so this deep dive, it's really shown how tracking that synchronized cumulative delta across ES, NQ, YM, and RTY, and doing it during RTH, gives you this powerful lens into institutional intent. It offers a structured way to find those higher probability signals.
Absolutely. And it shows how these, seemingly separate parts of the market can, when they align, paint a much clearer picture of collective conviction. It really makes you wonder, doesn't it, what other subtle convergences in market data might be out there, revealing hidden truths about the market's real underlying sentiment, maybe even beyond just futures.